How can position sizing protect crypto leverage trades? Imagine riding a roller coaster that can go up and down in seconds. Now, think about how much control you have over your ride. That's what managing your trade size is like in crypto leverage trading. When you use borrowed money to increase your position, your gains can grow quickly. But so can your losses. That's where position sizing becomes your safety net. Position sizing is about deciding how much of your total capital to risk on each trade. The rule of thumb is to risk only a small percentage of your total funds, usually between 1 and 5%. For example, if you have $10,000, risking 2% means risking $100 on a single trade. This way, even if the trade goes badly, your loss stays manageable. Now, when you add leverage into the mix, things get more intense. Leverage allows you to control a larger position than your actual money. For instance, 5 times leverage means $1,000 controls $5,000 worth of crypto. While this can boost your profits, it also magnifies your losses. A small price move against you can wipe out your margin and trigger a liquidation. That's when the exchange closes your position to prevent further losses. Position sizing helps prevent this from happening. It acts as a buffer, limiting how much you can lose on each trade, no matter how much leverage you use. To figure out the right size, many traders use the formula: account size times risk percentage, divided by the distance to your stop loss. The stop loss is the point where you decide the trade is wrong and exit to limit losses. For example, if your account is $10,000, risking 2%, and your stop loss is 5% below your entry point, your position size would be $4,000. This means you can enter a trade with $4,000 while keeping your maximum loss at $200. This approach keeps losses predictable and manageable, especially during volatile market swings. Position sizing also interacts with margin requirements, exchanges requiring you to maintain a minimum margin level. If your losses exceed this, your position gets liquidated. Proper sizing reduces the risk of hitting that margin call, even during sudden market drops. It keeps you in control instead of letting the market decide your fate. Advanced strategies like hedging also relying on proper position sizing. If you hold a large long position in Bitcoin, you might open a smaller short position to protect against a price drop. Sizing your hedge correctly ensures you don't overexpose yourself to new risks. In short, position sizing is a key tool in managing risk in crypto leverage trading. It limits your losses, helps you avoid margin calls, and keeps you in the game longer. By sticking to consistent sizing rules, you can protect your capital, use leverage responsibly, and improve your chances of success over time.